What do you get when what used to be considered the world's safest assets start looking not so safe? So much so, in fact, that some of the smartest financial minds in the world are divesting. It's a financial plot twist worthy of a Hollywood thriller. Let's unravel this mess. Coming up. Welcome back to the smartest financial minds on YouTube. And for those of you who don't know me, my name is Steven Spicer. And I think the reason that when I published Stop Investing Like They Tell You, that the reason that it hit number one on Wall Street Journal's bestseller list is because deep down, people know that we have some massive challenges on the horizon that most financial advisors just want to pretend don't exist. And this, the idea that investors might be moving on from the United States, is one of those unsettling propositions that most investors would just rather pretend to be a siren song of a doomsayer. But for those who are paying attention, it becomes pretty obvious that no, this isn't some vague conspiratorial tinfoil hat theory. In fact, just recently we had it straight from the mouth of Minneapolis Fed President Neel Kashkari, and backed by data you're not going to want to ignore. So let's start with the weirdness in the bond market. Historically, when the global economy gets spooked, investors pile into US Treasuries like it's Black Friday at Costco. That demand drives bond prices up and yields down. But recently, we've seen the opposite. Yields are spiking, especially on the 10-year and 30-year Treasuries, levels we haven't seen since the early days of the Trump administration. And when bond yields rise like this, it usually means investors are demanding more compensation for holding what's supposed to be the world's safest asset. Translation? Investors are nervous. But wait, it gets better or worse. At the same time that Treasury yields are surging, the US dollar is falling hard. But historically, the threat of elevated tariffs leads to a heightened valuation of the US dollar. But this time, they're moving in opposite directions, which has economists scratching their heads. Now, back to Kashkari. His take? That these two moves, higher yields and a weaker dollar, may be telling us something deeper, that investors, both foreign and domestic, are starting to question the long-term viability of US debt and the dollar itself. Not because the system's broken yet, but because confidence is eroding. And confidence is everything in finance. It can't be everything in finance. And by the way, if you're concerned, that's why we created our Financial Doomsday Survival Guide, taking you through step by step all the biggest risks to which traditional financial advice leaves you extremely exposed, as well as the best solutions we've found to date to overcome and sometimes even eliminate those risks. I'll link out to that in the description. But for this particular issue, let's look at what the biggest players in the market are doing. RBC Blue Bay Asset Management, for instance, is betting against the US dollar. Their thesis? There's a steady erosion of faith in America's economic policy direction. They're reallocating funds towards the Japanese yen, which they think is going to strengthen as Japanese investors start bringing money back home instead of parking it in the United States. Meanwhile, Bank of America recently surveyed 164 fund managers, overseeing nearly $400 billion in assets. The result? Pessimism about US assets is at a record high. Global growth expectations are now at a 30-year low. These guys are yanking money out of US stocks and plowing it into things like gold and utilities, classic defensive plays. US industrials, tech, banks, they're getting dumped. Gold, by the way, is hitting record highs. More details on why it's doing so well and what to expect for the future in a bit. And if you're wondering whether this is just short-term panic, it's not. Nearly 2/3 of those surveyed said the dollar is overvalued. The dollar has already fallen nearly 10% since January. Some of that seems to be tariff-induced, but the rest, that's good old-fashioned investor anxiety. Deutsche Bank even warned of a looming crisis of confidence in the dollar, one they're comparing to the collapse of the Bretton Woods system in 1971. That's a big deal. Meanwhile, domestic concerns are already materializing. The housing market, which had finally started to show signs of life, just got kneecapped. Trump's new tariffs sent mortgage rates spiking, the largest jump since last October. Why? Because bond yields are rising and mortgage rates follow those like a shadow. According to the Mortgage Bankers Association, home purchase applications fell 5% last week. Refinancing, down 12%. That's after weeks of steady improvement. MBA's chief economist said the uptick in rates, coupled with rising economic uncertainty, might make people hit pause on buying a home, even if they're still better off than last year. The timing couldn't be worse. The housing market had just started picking itself up off the mat, and now it might be headed back down to the canvas. And across the pond, Europe's enjoying a little schadenfreude. Normally, it's the US that benefits from the so-called exorbitant privilege, being the place everyone parks their money in tough times. But now, European governments are seeing their deficits funded at no extra cost because capital is flowing their way. And they didn't even have to ask politely. Let's zoom out further. Over the past few decades, the US has held a privileged position in the global economy, not just because of our size, but because of trust. Trust in our institutions, trust in the US dollar, trust in our ability to repay our debts. But when you combine record deficits, a politicized central bank, weaponized trade policies, and an increasingly divided political landscape, well, trust starts to wobble. Let's not forget, this isn't just about bonds or currency. This shift in sentiment touches everything. Equity valuations, foreign direct investment, interest rates, even the US tech sector. Think about this. During the 2010s, American tech companies were the darlings of global capital. They were magnets of sovereign wealth funds, pension plans, foreign central banks. But today, investors are increasingly turning their eyes to India, Southeast Asia, and yes, Europe again. Capital follows confidence, and confidence in the US is teetering. Take Saudi Arabia, for example. We've talked about this before in other videos. Once a loyal buyer of US treasuries, it's now reducing its holdings. In early 2023, the kingdom's treasury stockpile fell below $100 billion for the first time in years. Meanwhile, they're signaling deals in Chinese yuan, selling oil to countries without requiring US dollars, and actively participating in BRICS discussions about a reserve currency alternative. And China? Already moving full speed away from dollar dependence. They've inked trade agreements with Brazil, Russia, and Iran settled in the yuan. The People's Bank of China has reduced its US Treasury holdings by over $300 billion since 2018. They're not just diversifying, they're sending a signal. Even Switzerland, known for its neutrality and financial conservatism, sold off more than $80 billion in US Treasuries over the past 12 months. They're not throwing a tantrum, they're managing risk. And if you're thinking, well, sure, but where else are they going to park their money? Consider this. More sovereigns are building up their gold reserves. Central banks around the globe bought a record 1,136 tons of gold in 2022 and nearly matched it in 2023. According to the World Gold Council, this was the highest level of gold accumulation since records began. Why? Because gold doesn't default. It doesn't inflate itself, and it doesn't tweet. Even the International Monetary Fund, the IMF, whose job is basically to worry about this stuff in 12 different languages, has quietly issued warnings about global exposure to the US dollar. In a recent working paper, they acknowledged that the greenback's share of global reserves has dropped from over 70% at the turn of the century to below 58% today. And the shift isn't moving to any one currency, it's fragmented. Euro, yen, yuan, gold, crypto. The trust pool is diversifying. And that diversification has real consequences. If demand for US debt declines long term, interest rates will have to rise to compensate. And when rates rise, everything gets more expensive. Mortgages, car loans, business capital, government borrowing. That means more taxpayer dollars going to interest rather than roads, schools, or, let's be honest, more stimulus. And let's talk about inflation. If demand for the dollar weakens internationally, the cost of imports rises. A weaker dollar might be good for exporters, sure, but it's bad for everyday Americans who buy phones, clothes, and cars made abroad. And it's a disaster for countries that hold their reserves in dollars. Remember the Asian financial crisis of 1997? Much of it was sparked by pressure on dollar-pegged economies. If history rhymes, we could expect tremors in emerging markets too. Meanwhile, back in the US, the Federal Reserve has less and less room to maneuver. Rate hikes risk crushing already leveraged sectors of the economy. Rate cuts risk stoking inflation and feeding the narrative that the US has lost fiscal discipline. It's a lose-lose limbo. And just in case you think we're overreacting, consider this. The Bank for International Settlements, this sort of central bank of central banks, published a recent paper titled The Future of the Safe Asset. In it, they explored scenarios where US Treasuries lose their special status. Not because the US collapses, but because the world moves on. Quietly, gradually, maybe even reluctantly, but deliberately. So what does this all mean for you? First, it means the 60-40 portfolio, that classic mix of US stocks and bonds, isn't a bulletproof plan anymore. Most financial advisors will just stick with what has worked in the past until it doesn't. Then they'll adjust out of necessity, but at the same time, that could leave you and millions of others in financial ruin in their wake if you don't wake up to this reality. Again, our financial doomsday survival guide walks you through all of this. But yeah, since both halves, stocks and bonds, are under pressure, you need to get creative. Hard assets matter. Real diversification matters, not just between tickers, but between asset types and jurisdictions and strategies in general. Second, it means don't count on the dollar always being king. You don't have to abandon it, but maybe don't tattoo it on your chest either. And third, it's time to stop thinking like a retail investor and start thinking like a sovereign wealth fund. Where is the world's smart money going? What are central banks doing with their reserves? What assumptions am I making that might be outdated? Look, this isn't about fear, it's about clarity. If you know the weather is changing, you don't panic, you pack an umbrella. And if you've made it this far into this video, you're already in the top percentile of people who actually pay attention to what's going on behind the headlines. So do the rest of your portfolio a favor, do your future self a favor, and act accordingly. You can start with the survival guide link in the description. Then, this video is going to walk you through why gold is doing so well and what to expect for the future. I'll see you there.